Good afternoon, ladies and gentlemen. Thank you for joining us in this joint Wealth and Asset Advisors and Sasfin Wealth webinar. Just to give you some structure for this afternoon's webinar, first of all, we have Jeremy Squier, which will just give you a short history and background of the partnership between himself, his team, and Sasfin Wealth. After that, Erol Zeki, the Chief Executive Officer of Sasfin Wealth, will just give us a quick update on Sasfin's strategic reset, which we embarked on about 18 months ago. And then after that, I will introduce Jonathan Wernick, which is our Chief Senior Global Analyst, and he will talk to us about the big theme that everyone is talking about, the artificial intelligence. So without further ado, I will hand over to Jeremy Squier. Thank you, Jeremy.
Thanks, David. And thanks to everyone for joining us, and to Sasfin Wealth for putting on this presentation. If we can just pull up my slides, there we go. Just going to give as everyone knows, we've just recently undergone a management buyout of our business, and so this represents a new chapter for us. I'll just wait for the slides to come up. There we go. Yeah. Okay. Thank you. So it's a new chapter for our group. If the next slide up, please. And just a brief history of our group is shown on the slide there, where in essence, even though we have a new name and a new brand identity, it's the same people and same team-based approach, which started over 36 years ago, with my having joined Liberty Group and then moved into the Sage Group, both brilliant organizations at the time, and then having gone independent in 2002, which is when our affiliation with Sasfin started. And it's been a very strong and enduring affiliation since, and we're looking forward to taking it to the next level. In 2007, I helped found Wealth Associates, and then in June 2025, this year, my team and I did a management buyout and created Wealth and Asset Advisors. And so we look forward to the next chapter. Next slide, please. Yeah, and on there you'll see that our philosophy towards life and business is that life is a team sport, and the success lies strongly in strong leadership and surrounding yourself with strong players. And we're very proud to have a number of core providers as part of our team, and in that we certainly include Sasfin Securities, Sasfin Wealth, and then the other names that you see there, and they're all very much a material part of our success in the past, and our ability to provide quality advice and service to our extensive client base. I'm going to hand back to David to introduce Erol, or maybe Erol's going to jump in directly. Thank you.
Thank you, Jeremy. My apologies for the start there. I had some echo on the sound. I didn't introduce myself. My name is David Bolt. I'm the branch manager of the Sasfin Wealth Pretoria office, and I'm also a portfolio manager with 27 years worth of experience. And between myself, Nicholas Sarua, also a portfolio manager with 25 plus years experience, and Michelle Best, also with 25 years experience, we assist Jeremy and managing his clients' portfolios locally as well as on a global basis. But over to you, Erol, to give us just a quick background of how we are doing on our strategic reset. Thank you.
No, thank you, David, and thank you, Jeremy. We really enjoy the association. I'm very proud of it, and thank you for that. And just wishing you all the best as you take on your new chapter. We've also had quite a few changes. So, as David said, as a group, Sasfin announced this reset probably about 18 months or almost 2 years ago now. And we made quite an important announcement earlier this week. And really it is that the bulk of the strategic reset is just about done. And that Sasfin will be focusing on its core business as being Sasfin Wealth, which is this business, as well as our rental finance business, which is called Sunland. And for those of you that have been to the Pretoria office, you'll see that Sunland also has an office just, I think, across the corridor from Sasfin Wealth. So, the last of the transactional banking clients, which were linked to Hello Payzer, which is one of Sasfin Bank's alliance partners, moved to Bidvest Bank last week. Is about 200,000 clients, which really means that there are no more transactional or core banking clients left in Sasfin. The group's also, over the last 2 years, raised about 2 billion rand in funding from the leading South African banks and institutions, some of it in the form of securitization, which the group's been doing for about almost 30 years, actually more than 30 years now, and the rest through debt facilities. And really that is to support Sunland in its rental finance activities, but it also enables Sasfin to relinquish its banking license. And we remain on track to complete this by the end of the year. So going forward, really, Sasfin will be an investment holding company focusing on distinct financial services businesses, starting with the existing businesses being Sunland and Sasfin Wealth. And for us at Sasfin Wealth, we're very excited about, for more than a decade now, Wealth has operated mostly independently. We've been supported by our own board of directors and our own management team, as well as all the other support services that we require. And we've really developed over many, many years a robust global investment capability. And, we've broadened our offering from private clients to corporate institutional client segments as well. And we've also significantly enhanced our private markets offering, which is another thing that David and his team have been deeply involved in recent years. So really this transaction provides us an ideal opportunity to really define our future. But just to be clear, we don't see this as a change or some sort of reinvention. Really, we're using this as an opportunity for a clearer and more focused expression of who we are. So, our essence, if you will. And so we see ourselves as an independent standalone business. We've got over a century of history in financial markets within Sasfin Wealth, going back to 1890. And really, it's to articulate our unique positioning and strategic direction. And so to complement this, we will also be announcing a new brand and identity in the coming weeks, which we're also very excited about. So, just thank you very much to all of you for your support. Many of it's been over many years and some over decades. And as Jeremy said, association with him and his team for a very long time. And just to say a big thank you to David and his team. They're an incredible team. They've got deep expertise, lots of experience, and they've been intimately involved in this process of getting us ready for what's next. Yes, we look forward to sharing more about this with you in the next few weeks. But yeah, that's all from me. Thank you very much. I'll hand back to David who will introduce our presenter for the day.
Thank you, Erol. We are very excited about what the future holds for Sasfin Wealth. We also not privy to the new brand yet, but we're super excited. It's really re-energized us, the whole process that we've gone through to understand ourselves as a business. And so we will continue to offer superior investment products and solutions for our clients and for businesses like-minded businesses like Jeremy's business. So just a quick introduction. Jonathan Wernick is one of the members of our research team. He serves on the Sasfin Investment Committee, and he's the senior global equity analyst. I asked Jonathan to spend some time on a very interesting topic, artificial intelligence. It seems like the machines are rising, the machines are taking over. I asked him to try to keep it really simple because it is actually quite a complex topic. But yeah, without further ado, Jonathan, thank you for your time. We really appreciate it. Look forward to your presentation. Thank you.
Thanks, David. Just want to thank everyone again for coming to listen to me speak today. I hope you find it quite entertaining, hopefully. But I think the first thing I'm going to do is just start off with a bit of an apology. If I do sound a bit funny, I'm currently battling a cold, and truth be told, I think I'm losing the battle at this point. But that's the only apology I'm going to be making today. The subject matter that I'm about to show you, I think, deserves no apology. In fact, I think it's almost critical to have a basic understanding of what is standing in front of us at this point in time in terms of artificial intelligence. And just before I go through the presentation, David, can you just confirm you can see my screen before I get ahead of myself?
Yes, we can see it. Thank you, John.
Okay, fantastic. So I've broken up the presentation into two parts. The first is basically trying to give you an understanding of the investment landscape for artificial intelligence, where you can invest. And then the second part is just our approach in terms of how we would apply our investing approach to investing in the AI theme. So before we actually get into investing in artificial intelligence, I think it's just worthwhile taking a step back and defining what is meant by artificial intelligence, because the term AI gets thrown around a lot. But I think simplistically, and the way I think about it is artificial intelligence is basically teaching a computer to mimic human smarts. To me, it's software that learns from data to make decisions and predict outcomes or automate tasks. You can think of AI as a superpowered pattern spotter, if you want. You can feed it tons of examples, maybe photos of cats, and it figures out common traits so it can recognize new cats on its own. There's no magic, it's just maths and algorithms crunching information at lightning speed. Another thing worth mentioning is AI has actually been around for a while. We just call it something else when it becomes mainstream. If you are sitting at home and you can't decide what to watch on Netflix and you get a suggestion from Netflix, that's an example of AI. It's a computer looking at your past viewing patterns and determining what you might like based on probabilities. When you look for a destination on Google Maps or Apple Maps, and a direction or a route pops up, that's again a computer performing the task for you. Even predictive text is a form of artificial intelligence. The thing is, though, AI really has the potential to be transformative. If you look at some of the potential use cases, autonomous vehicles that could reshape the automotive and logistics industries, robotics could lead to a completely different factories in the future. Basic chores, care for the elderly and sick could also be performed by robots, and you can free up time, which would lead up to increased productivity. Personalized medicine could lead to significant improvements in healthcare. By analyzing the abundance of data at our disposal, patients can receive personalized treatments for their conditions at a much faster rate than we used to. And then I'm not going to spend too much time on this because it's got more detail later on, but agents, that's basically AI doing tasks on our own behalf. That could really change how things are performed in the workplace. So when I mentioned a computer performing tasks, the computer that I'm speaking about isn't the one you're probably watching this presentation on. What I'm really referring to is a data center. Now, a data center is really a giant computer filled with lots of other little computers. It's all these servers that have these trays that have these microchips or AI chips or semiconductors or GPUs, however you want to call it. And you've got hundreds and thousands and going forward, even millions of these AI chips in these data centers. And effectively at warehouses is a massive amount of compute that builds or trains and runs or inferences AI models. What you have to understand is compute inside these data centers is evolving. So these data centers, these big buildings, most of them, or the big ones, are run by what they call hyperscalers. These are companies like Amazon, Google, Meta, the company behind Facebook and WhatsApp and Instagram, Microsoft. These hyperscalers have already built lots of data centers. But these data centers are filled with what you call general purpose compute. They're filled with CPUs, which basically run web servers, recommender engines, virtual machines, databases, enterprise software. But going forward, these data centers and the new ones that will be built are going to change into accelerated compute, or GPU accelerated data centers, or what some people call AI factories. Inside these new modern data centers, you're going to have AI training and inference, real-time data analytics, scientific simulations, generative AI that's basically creating images, audio, video just from text prompts. You're going to have reasoning models. That's when the AI starts thinking for itself. Another way of thinking about this is your traditional data centers were basically just retrieving stored data. The future data centers are going to be creating data, thinking and generating. Why you probably need to pay attention as an investor is that over the next few years, these hyperscalers, these big tech companies are expected to spend over $1 trillion building out these data centers. In 2024 alone, they spent $250 billion. By 2030, the spend on data center infrastructure could reach between $3 and $4 trillion. Just to give you some context of how much that is, some of the world's biggest industries, life and health insurance, oil and gas, commercial banks, that's the size of those industries in terms of revenue. South Africa's GDP in dollar terms is only $400 billion. So now to maybe more of the useful part. In terms of AI, and you're thinking about investing in this theme, where can you invest? And what I would say to you is think about 3Ds: data centers, devices, and deployers. Data centers, these are the companies that are involved in building out the infrastructure, be it hardware and software for data centers. Devices, companies that can build devices that can run AI, and deployers, companies that are developing digital agents to improve productivity. So let's start with data centers. You can almost think of a data center as a big box of compute. And if you go inside the box and you look at a cross section, what's inside this data center? We've covered the first part, which is the chips. So if we just go into a little more detail about those chips, let's just call them AI chips, these semiconductors that you hear about. The way I like to think about semiconductors is almost like building a house. Before you can even build a house, you need to get blueprints. And to make blueprints, you need some kind of software to draw them up. Then you need an architect to actually draw up the plans. Then you need a builder to take the architect's plans and build it. And to do that, you need special construction equipment. It's very much the same with semiconductors. You get special software to design semiconductors. And then you get companies like Cadence, Arm, Synopsys. They provide that kind of software. Then you get the designers, the companies that actually design the semiconductors using the software. That's where the company NVIDIA, the world's largest company, sits, as well as Broadcom, well as also one of the largest companies in the world, as well as AMD and Marvell. Once they've got the plans, they send it to the manufacturers, or what they call in semiconductor space, the fabrication plants. Now, the biggest game in town here is a company called TSMC, Taiwan Semiconductor Manufacturing Company. They are the biggest fabrication plant company in the world, and they make the world's most advanced semiconductors. What I've also highlighted there, just in a little blue block, is two companies, SK Hynix and Samsung, and they make memory chips. Now, memory is not really an AI chip, but when it comes to AI, memory is very important. Building AI models and running AI models requires a lot of memory. So these two companies could also benefit, even though they're not maybe AI chip makers themselves. And of course, to make the chips, you need very, very specialized equipment. And this is where companies like ASML, Lam Research, KLA, Applied Materials, Tokyo Electron come into play. So that's the chips. Those chips I mentioned were put onto racks and servers, and then they need to be connected to one another. You've got these hundreds of thousands of chips in a data center, they need to talk to one another. There needs to be networking. And when it comes to networking, there's a lot of different components. There's switches, which basically direct the traffic within servers in the data center. You get interconnects that allows the memory chips to talk to the AI chips and various other components. You maybe want to speed up signals. You want to optimize the data to be very fast. Obviously, in data centers, there's lots and lots of cables. So companies that make fiber optic cables or copper cables could do well. And you get integrators that basically take all these bits and pieces and build the networking equipment. There you get companies like Arista Networks, and even some of the hyperscalers do their own assembly. Something that's happening in the data center world, which is quite interesting, is in the past, you basically got scale up, which is where you just tried to get as many GPUs and memory together in one server. But now we're moving into scale out, connecting as many servers as you can together. And what they want to do in the future, and this is the next step, is when you start connecting different data centers to one another, and then you've got millions and millions of chips communicating to one another. And this is where networking becomes very important. The thing you have to understand about data centers and how they're evolving is in the past, they used power, but not a lot of power. But with these new AI chips, these data centers use a lot more power. They're very power hungry because of these AI chips. And because of that, they become very, very hot. So when you look at data centers, the one thing is you've got to get the power in, but then the other part is you've got to keep the data center cool. And in terms of keeping it cool, in the past, air conditioning worked fine. But because they're getting so hot now, so hot in fact that the chips could actually melt, they're having to introduce new cooling techniques, such as liquid cooling. In some instances, you even dip in some of the servers into liquid, or you apply liquid to the chips to keep them cool. So players in this space could also benefit as well. So from a power perspective, so companies that are building transformers, switchboards, switchgear, the likes of Eaton, Schneider Electric, Siemens, they could do very well and are doing well. From the thermal space, that's liquid cooling. A company like Vertiv is leading the market in these liquid cooling technologies, but there's other companies as well that perform like Invent and Schneider Electric. And in the air conditioning or HVAC side, there's a lot of traditional players, your Johnson Controls, Train Technologies, Daikin. A lot of players in this space could also do very well and are doing well. And then just stepping outside the data center, you've got to basically connect these data centers to the grid. Now, most of these data centers are being built in the US. At present, there's about 42 gigawatts of installed capacity in terms of data centers in the US. By 2030, this is expected to more than double to 100 gigawatts. Put differently, currently these data centers use about 183 terawatt hours a year. By 2030, that's expected to double to 426 terawatt hours a year. That's going to put the US power grid under a lot of strain. Those regions highlighted in red on the US map during peak hours might not be able to handle the demand. Because of this, you're going to have to build out more electrical infrastructure, be it generation, transmission, or storage. So companies that are producing energy, connecting different places to the grid, or storing energy could do well. Here you're looking at companies like Siemens, GE Vernova. In terms of storage, Tesla, BYD, a Chinese company, CATL, another Chinese company. Electricity producers could also do well, the likes of Vistra, Constellation Energy, utility companies as well. And of course, you're going to need engineers and contractors and consultants to build all this. So those type of companies can do well. Here you're looking at companies like Quanta Services or Comfort Systems. So that was data centers on the hardware side. Just moving on to the infrastructure side, or the software infrastructure side. So the software infrastructure layer serves as basically a foundation for AI, providing the necessary tools and resources to collect, store, and process and manage data effectively. So this software layer is all about the data and managing the data. So basically the foundation for these data centers from a software perspective are the hyperscalers and the software they provide. The companies like Amazon, Google, Microsoft, and even Oracle now are becoming big players. There's a couple of Chinese companies very involved. And you're even finding that you're getting these, what they call neocloud, very specific type of cloud service providers that focus just on the AI side. Companies like Iron, CoreWeave, Nebius. If you move up a layer, the data management itself, whether it's databases, data warehousing, the analytics of the data, this managing data is imperative when it comes to AI. So companies like Snowflake, Databricks, a private company, but still very prominent, even Confluent, and a company called Palantir, Oracle, they have a lot of databases from the past that are still used. They could also do very well during this movement. The next space probably gets the most airtime, but it's probably one of the hardest areas to invest in, one of the riskiest. And these are the companies that are making the frontier models. So ChatGPT, which is made by OpenAI, Meta AI, Anthropic have Claude models, Google have Gemini, XAI, the company owned by Elon Musk, has Grok. You've got a lot of Chinese companies playing in this space, and they've got their own models. And what you'll find, there are companies that develop these frontier models, whether it's ChatGPT, Gemini, Grok, or Claude, they train it on these vast data sets, the data managed by these data management companies, and they help organizations build their own AI solutions. And then lastly, as AI becomes more prevalent, the importance of cybersecurity escalates. These AI system processes generate vast amounts of data, some of which could be sensitive or proprietary. Cybersecurity ensures that the integrity and confidentiality and availability of this data. So cybersecurity is going to be very important as we move into an AI world. So that was the data center. The next D of the 3Ds is devices. And two areas that will become more of an issue as AI proliferates are latency, which is a fancy word for lag, and privacy. So to reduce latency and ensure data remains secure and private, the processing of AI will effectively shift towards devices on the edge. So these are devices that are computing outside of the data center, be it a smartphone, a laptop, or even a car. Companies that build, design, or supply components for these devices could also benefit. AI-capable edge devices will eventually become prevalent in both consumer as well as the enterprise space. So let's start with the consumer space. And once again, semiconductors stand to benefit as these devices are going to require increasingly complex and smaller chips, given their smaller size. So those that own the platforms will stand to benefit, though it remains uncertain whether current incumbents will be tomorrow's winners. It's possible that we'll see smart glasses or perhaps some kind of a new device surpass the smartphone as the dominant consumer device. And of course, autonomous cars will become more commonplace, and that's going to disrupt the auto industry as we know it. So your mainstream devices, your iPhones, your laptops, even your wearables, your smart watches, your AirPods, they're going to become more AI enabled. But going forward, what we might see are smart glasses becoming a lot more popular and used for AI. And then who knows if someone's going to come up with a new device. So in terms of the companies that could benefit here, you'd probably have to look at Apple. They haven't really done much in the AI space, but it doesn't mean they won't. Meta, the company, is doing a lot of work, especially on the smart glasses. They've even partnered with a company called EssilorLuxottica, the company behind Ray-Ban, to work on these smart glasses. Google's done very much the same. They've partnered with Kering, the company behind Gucci. Obviously, Tesla, when it comes to autonomous cars, is the leader, at least in the Western world. But then we can't rule out China. And then you've got companies like Baidu and Horizon Robotics that are very involved in autonomous driving. And I've gone through the semiconductor companies, but a lot of the same companies we mentioned for data centers would also stand to benefit when it comes to devices. If we move on to the enterprise now, companies that are able to effectively deploy AI to devices on the edge could experience sizable increases in efficiency. So there's 4 areas that could already are experiencing productivity gains. The first one's factory automation. So as robotic arms and AMRs, which is just basically an acronym for autonomous mobile robots, become more capable, the need for human workers in a factory will diminish. It's also possible that the rapid developments taking place in humanoid robotics, so that's robots that basically move around like humans, could lead to a proliferation of autonomous factories and warehouses. In the US, Amazon, Nvidia, and Tesla are certainly leaders in this space, but the Chinese arguably are even ahead of them in some areas. There you've got a company like Unitree, which is still private, but may go public. You've got Geek Plus, Ubitech. The Japanese are also very involved in the robotics side. And the Europeans, believe it or not, also have some companies involved there. Autonomous vehicles, more so on the farming equipment and construction and mining side. So farmers right now are even able to farm their land with fewer workers, as well as reduce wasted chemicals through precision agriculture. And that's because of AI. In a similar fashion, mining and construction are increasingly adopting autonomous vehicles to increase productivity as well as safety. If you look at defense, police officers in the US spend a lot of time doing admin, writing reports about incidents. Nowadays, police officers are able to save 2 to 4 hours a day by utilizing AI to draft their incidents reports using footage from their body cameras. The body cameras can take in the images and draft a report without a police officer having to write a word. All he has to do is approve what was written for him by AI. AI is also changing how battles are fought, whether it's on the battlefield with drones, cyberspace attacks, or even threats from space itself. Companies in this space that could do very well, Exxon from the law enforcement side, they're the companies that do the body cameras and tasers in the US. Palantir's very much involved when it comes to AI. You've got your traditional defense contractors in the US, your Northrop Grumman's, Huntington Ingalls from the sea side. And there's also a lot of private companies in the US, which could be very interesting should they list. There you've got the likes of Anduril or Shield AI. And then lastly, onto healthcare, we're seeing an increased usage of AI in medical devices, whether it's for diagnostics, imaging, or even surgeries. So there you're looking at companies like Intuitive Surgical, Stryker, Siemens Healthineers when it comes to imaging. And AI has already been used to provide personalized medicine to patients based on their medical data and could even be responsible for the next big drug discovery. And then moving on to the last of the Ds. So these are the deployers. What I'm really talking about here is agentic AI. So agentic AI is basically referring to artificial intelligence systems that act like digital agents. So these digital agents, they can perceive, reason, make decisions, and take action to complete tasks or workflows, often without needing constant human input. Just about every industry is now investing in these digital agents, from healthcare and finance to logistics, education, and retail. These agents are being used to automate customer interactions, optimize operations, and enhance decision-making. However, the most transformative impact, I believe, may come from companies deploying agents in back office functions. These areas are rich in repetitive rule-based tasks, and they are ideal for automation and potential gains in efficiency. And you can also reduce costs quite substantially. So if we look at finance, for example, companies like SAP or Intuit, the company behind QuickBooks, AI can automate a lot of the work that's currently being done. For example, you could ask AI to pay your employees just by sending an instruction. The employee can collect the hours from your employees. The agent can collect your hours from the employees and basically perform all those functions for you that you would have had to spend your time doing during the evening. SAP, they could resolve queries across multiple areas of its ERP system without having to employ a lot of people to do that. They could really benefit from that. If you look at IT support and customer service, HR, a lot of those functions also could be automated using AI. So if you look at our investment approach and how we think about investing in AI, I think the first place to start is, what is our investment approach? So we believe the best way to grow your portfolio over the long term is through compounding. And this has led us to adopt what we call a quality growth bias. It means we have a long-term perspective. We're basically looking for companies that we regard as high quality, that have got good growth prospects. And all of this leads to compounding. And what do we mean by compounding? Well, before we get there, if I wanted to define quality growth a bit more technically, a company can fall into the quality growth category if it possesses all three of the following characteristics. It has strong, predictable cash generation, sustainably high returns on capital. So the capital it deploys into the business, whether it's working capital or PPE, even people, it needs to have sustainably high returns on that capital, and it needs attractive growth opportunities. There's a lot of quality companies out there, but they just don't have the growth opportunities. We want companies with those growth opportunities, and AI provides a lot of those opportunities. So each of these characteristics would be desirable in their own right, but if they combine, they can be incredibly powerful, and they enable a virtuous cycle of cash generation. If you generate high returns on capital, you generate a lot of free cash flow, you can reinvest all that cash flow back into the business and generate high returns on capital again. So quality growth investing is about finding companies that can do this. And why do we invest this way? We come back to that idea of compounding. So I don't want to spend too much time here, but I think it's worthwhile just illustrating the point. If you start with R1 million and it compounds at 8% for the next 20 years, 8% per year, that 1 million rand will turn into just shy of 5 million rand. If that same million rand compounded at 10%, it would, after 20 years, it would be worth just shy of 7 million rand. And at 12%, it would be just shy of 10 million rand. The point is, small differences in the rate of return that you earn on that money make a big difference down the line in terms of compounding. So if you compounded at 12% instead of 8%, so that's just a 50% increase. You more than double your money if you compound over a long period of time. One thing you have to realize about compounding is it's not a linear trajectory. It's an exponential trajectory. What that means is a lot of the growth takes place in the latter years. You don't get a lot of the compounding benefit in the early years, but it's in the latter years where it really starts to matter. And because of that, it's very, very important that you don't interrupt the process of compounding. How this relates to quality growth stocks is that quality growth stocks compound. As I mentioned, the profits are reinvested and the future profits or interest are reinvested again. And so the cycle repeats. Very similar to the concept of compound interest. It's rumored that Albert Einstein once said that compound interest is the eighth wonder of the world. So how do we apply quality growth approach? So the first thing we have to do is develop a universe of stocks that we would consider quality growth companies. And we're bottom-up investors for the most part. So that means we're looking at companies from their fundamental perspective. The problem is, in a global universe, there's more than 20,000 stocks. We can't look at 20,000 stocks from a fundamental perspective. So we need to filter out the stocks that we don't think would be quality growth. So our first filter is we start from a regional country perspective. So we try and avoid areas that we deem have excess political risk, economic risk, or currency risk. Then we move on to sectors or industries. We try and avoid companies that are in industries that have low returns on capital or have volatile returns on capital, that are highly leveraged, i.e. they have too much debt, or they're opaque, i.e. it's very difficult to understand the industry or the companies within the industry. We also filter on size. While we're not too concerned about companies being too small, we do have a minimum filter of about $5 billion. Then we move on to the quantitative filters. Here is where we filter for companies that have got high returns on capital, and we regard those returns on capital as being sustainable. We also look for companies that have adequate growth prospects in terms of sales, free cash flow, economic profits, and we also want companies that have got low gearing. So we filter out companies that don't possess those type of quantitative metrics. And then lastly, a more qualitative filter, we want companies that we regard as having an economic moat or competitive advantage, which enables them to sustain those high returns on capital. We also look at how they make money. If there's any concerns we have around that, we might filter them out. If there's anything funny about the company, be it management, how they go about doing business, we might filter them out. Do we think their business is scalable? Again, as I mentioned, there's a lot of quality companies out there, but they might not have a lot of growth opportunities. So we want companies that have got either growing or large addressable markets. And then we also look for companies that have accounting practices that we would regard as being weak, or the technical term dodgy. So if we apply these filters, we basically start off with over 20,000 stocks and end up with a universe of about 300 stocks. From that point, we can start looking at the companies in a bit more detail. And from a high level, what we're looking at are looking at the companies from a financial perspective. So their returns on capital, their growth opportunities. We look at the business themselves, which includes looking at their industry, their customers, their competitive advantages. And then we look at the people, so the management running the company and how they allocate capital. So just to put it into a bit of a framework, we try and understand the company. We use quite a detailed checklist when looking at the people, the business, and the financials. We also look at what's priced into the current stock price. We try and gauge what the market is pricing in, how much growth, what profit margins, to see if there's any opportunities. So when we're looking at the people, the business, the financial, what we call a competitive strategy analysis, we look at the historical results. And this helps us determine what matters for the company, what really drives the company's fundamentals and ultimately the stock price, what we call triggers. And then we look at the company in different scenarios. Maybe if they're not doing so well, what we think would be a base case, and if things really did well or went well. And through these different scenarios, we can derive different values for the company. And we apply probabilities to those different scenarios, and gives us an estimated expected value for the company. So we don't just have one value. We've got different values based on different probabilities. So it's a range of values for the company. And using this expected value, we determine whether or not there's a margin of safety before investing in the company. Is the company got an intrinsic value that's sufficiently higher than its current share price? And then lastly, do we think this company is going to generate an expected return above our hurdle rate? So for example, if we want to earn, say, 12% on average per year on our investments, do we think buying it at the current price would give us that opportunity? So if we look at our framework and the companies we've just shown you I've shown you in the previous slides, these are the companies that would probably pass the test in terms of what we consider quality growth names. Doesn't mean they'd be good investments at this point in time. Some of them may be at prices that are just too high to yield an expected return that would be adequate for us. Maybe something's changed in the business quite recently, but for the most part, a lot of these companies we could consider quality growth companies. And with that, I've reached the end of my presentation. David, I don't know if you want to move on to the question section.
Thank you, Jonathan. Very comprehensive. Every time I listen to you, I think I understand it a bit more, but I think it's a very exciting area. And luckily for us, in our global equity strategy, we've had proper exposure in many of those names, like the Microsofts, the Amazons, and the Nvidias, and we continue to hold them. Just for the audience, if you have any questions, please do pop them into the chat, and we will address your questions. From my side, Jonathan, I think just a quick question. My sense is that we still very much in the early part of this AI boom, if I can reference that. Do you agree with that statement?
I do agree with that statement. I'll just back up a bit and say a lot of people are throwing the word bubble around now when it comes to AI. And you could quite easily draw a comparison to what's happening now to previous bubbles. It's very easy to draw a line. And there's arguments to say that that could be true. But I think what's happening now is a little different in the sense that the companies that are driving the so-called bubble are very different from the ones that drove bubbles in the past, in that they have a lot of cash to spend. They're very, very profitable companies. So there's not a risk of them going bust at all. That's not to say that this bubble, we can't reach a situation where these stock prices reach levels that are beyond the fundamentals of the company and become too extreme. But I don't think we are at that stage yet. We could get to it. Predicting the future is very difficult, but I just think we're at the beginning stages of a fundamental technological shift that could really change a lot of things in our life, whether it's at home or in the workspace. And you'd probably want to be exposed to companies that are involved in this, just to get the benefit of that growth, which I think has got a very, very long runway ahead of it.
Jonathan, could I ask two questions that some of the attendees popped through to me?
Sure.
The one is there's quite a lot of anticipation around this Optasia listing, which is, it's not pure AI, but I mean, they use a lot of AI in their processes. And then the other one relates to the rare earths, which of course are so critical in terms of the whole, all the components that you spoke about. So got any kind of insights on either of those topics?
Sure. Maybe I could start with the second one, and on Optasia, I might ask David to just share his thoughts, and I can piggyback afterwards. But just on the rare earth metals, just to give some context on what's going on here. So America has a lot of influence over China when it comes to semiconductors, in terms of America controls the IP around making semiconductors, as well as the supply of advanced semiconductors that would be shipped around the world. So they call it a choke point. It's basically a position of leverage, and America is currently using it against China. What's happened subsequent with America basically denying China access to these advanced semiconductors or AI chips? China has their own choke point, which is these rare earth metals, which are used in semiconductors, but also in various other industries as well. They're very critical into the automotive industry. And they're basically controlling the supply of those rare earth metals. Now, the issue around rare earth metals is not so much the availability, but it's the processing as well. And America used to be in a position where they dominated the industry, but they kind of gave it up and didn't invest in it, and China surpassed them, and now China has their own choke point. My own sense is that I think the two will eventually come to some agreement in terms of trade, and they'll keep these choke point semiconductors and rare earths in the background as bargaining chips. But I don't foresee the Chinese completely stopping access to these rare earth metals for the US, because they're still very reliant on the US for other things, as well as selling them these rare earth metals. So I think it's basically just used as a bargaining chip at this point in time. In terms of, I don't know if the question was about investing in these companies, I would just say that it's probably more of a speculative play at the moment, which is not a space we really play in, but there is a scarcity of supply. So I'm not saying you missed the boat, but the boat has left the harbor, and it could come back very soon. So it's not a space I would recommend as an investment, but as a speculative play, who knows?
Thanks.
David, I don't know if you want to, or Nick, if you want to go in on Optasia first.
Surprise! David grew hair. It's Nicholas here, one of the portfolio managers. Johnny, thanks for that. It's always really insightful. Just on your question, Jeremy, regarding Optasia and the upcoming listing, it is an interesting business. I think it kind of surprised a lot of us. I didn't hear much about it until the JC started to make waves about the company listing. And it is an interesting business. It's a very new business. It's a company that was founded in 2012. And what they brought to the table was a proprietary, AI algorithmic system, but specifically for how they do their business. And what they do is that what they are trying to achieve essentially is to try and assist the unbanked. There's a huge population in the world, roughly 1 billion people, that don't reach the threshold that allows them to go through traditional banking services. The one thing that they all have in common, besides not being able to gain access to the proper financial institution, is they all have a phone of some kind. And that's all you really need and I'm not talking about a dumb phone here. Most of these individuals will have smartphones. I mean, you can pick up smartphones that are not that expensive, and all those smartphones have all the necessary equipment on them to run the software that will allow these individuals access to what you would call micro and nano loans. So we're not talking small loans, we're talking incredibly tiny amounts. I mean, you would probably look at a $5 loan, which is not even a couple of rands, less than $100, that would then be borrowed to do whatever the individual wants to do with it, and then be paid back the following week, as an example. But it's the proprietary system that they have that allows them to essentially vet the individual when it comes to the potential of them actually paying back that loan. I mean, that's the essence of it. So that's what would set them apart, I would say, to other companies in the sector. Their proprietary and tested algorithm for lending out this money, those individuals reaching that threshold, and then it's a very interesting growth sector because it is really underpenetrated. I think that's what the company's trying to do. Now, these 1 billion individuals generally exist in emerging markets. The majority of them will be in Africa, but you'll also have some of them in Southeast Asia and so on. So the biggest markets for Optasia would actually be Uganda, Nigeria, Pakistan, South Africa as well, but still a good growth potential. And I would say the reason for them listing in South Africa, which is interesting. I mean, they are a Dubai-based business. They're not listed at the moment, but they picked South Africa because they felt that South Africa, even now, is still the most advanced African nation, and I think they would really wanted to tap our markets. They're looking at raising about $75 million for two reasons. The main one is obviously to grow, but also for first entries into the business to actually get out. These are the individuals that were right there from the beginning. So how they run their business is they would go to one of these mobile operators. They've got great contracts with Vodacom, MTN, and Airtel, plus a whole bunch of other operators I've never heard of before, but they obviously exist in other parts of the world that I'm more unfamiliar with. But essentially what they say is they say, guys, we need to get onto your system, get your customer, and what we'll do actually is we will provide you with this opportunity and we will share a little bit with you. So what's interesting about Optasia is they don't actually lend the money. They will then go to a financial institution and they'll say, hey, Mr. Bank, this is who we are, this is what we do. We will sign that we will be, essentially, we will be good for any debt. So any default that occurs is up to Optasia to cover. The bank says, well, that's fantastic, reduces our risk. We'll go after you if there's anything. And therefore, the banks are more willing to lend this kind of money out to unbankable individuals. So it's a very interesting business model. It's nothing brand new. I mean, it's been done before. I would even say that companies like Capitec have done something very similar and will probably continue to do that. But it's very interesting to see a pure entry join our market and look to raise capital. Now, the risks that I see is that it is a brand new listing. The company is relatively new. It's grown exponentially. It's very difficult to have a look at what their data was like about 5 to 6, 7 years ago. They don't really provide that. So it's difficult to look at what the company did during cycles. You go through, like anything in life, there's a cycle. You'll have a lending cycle that will be beautiful and then it will go against you. It depends how strong you are and adaptable you are and how much you have on hand to basically cover that debt. So, I mean, if half your customers can't pay back the money because there's been an issue, you're liable for that. So that's the one risk. Well, I would say the major risk. The second risk is competition. They're not the only company doing this. So interesting. I think it's a great service that they're offering. I think there's a lot of growth potential here, but it is a dicey environment. I think there are some inherent risks that are difficult to manage. But if they've got the correct system and they can continue with that, I think it could be very good. from our perspective, what do we do when something like this comes across our desk? Well, I think it's important, and this is what Johnny spoke to. I mean, that filtration system will go just as well for a global business as it would a business listed in South Africa. And with deepest respect to Optasia, I don't think at the moment that they would filter exceedingly well, just because we don't really have the history. We don't have, complete access to day one books. There's very little analyst views on the business at the moment. There's literally a handful of reports. So, we love to get to know a business intimately, and we might do so for a number of years. Palantir is a really good example. I mean, I know that we've been on that company's case for the last 2 years, and the share price continues to climb, but we haven't gotten our feet wet. It's all about risk at the end of the day. So Optasia is interesting, but it doesn't reach the thresholds of risk, in our opinion, to hold it. That doesn't mean we won't. I mean, there were many years before we held Capitec in our holding, and hindsight is the best side. But I guess it gives you some example, and it's great to see another business on the JSE. I think the JSE has been losing a lot of listings. It's good to see one jump on. So I think listing is very early in November. They are currently running a book build, which means they're going out to market saying, hey guys, here are all the shares that are available. I think pricing is between 15 Rand and 19 Rand a share. So how it would work in this case, for those that are interested, contact your broker, say, I definitely want, this is the amount that I want, and this is the price that I'm willing to pay. And that kind of goes into a little bit of an auction, and then you either get some or you get nothing. But officially speaking, we won't be going for that. So I think it's definitely a personal decision for each individual. Who knows? In 5 years' time, I might be eating my words and saying, "Oh, Optasia was the best looking sitting duck of a business," but better safe than sorry at the end of the day.
Thanks, Nick. Yeah, they got some fairly impressive names behind them. Michael Jordan, Nick Kohler, who was the MD of Hollard, of course, and some pretty. And also, it's quite interesting because I think that so it's essentially Time Bank and African Rainbow Capital recently delisted, and of course they hold a significant stake. So I think that well, obviously you can't invest in ARC anymore, but they're obviously going to hit the jackpot. Well, if the listing's successful, which it looks like it will be. So it's some pretty smart guys behind ARC as well. But yeah, no, I mean it's certainly not a kind of a granny's portfolio type stock. But thanks for your insights.
Unless your granny is really into risk, it's it's something for someone that wants to take a punt with respect. But we'll watch it closely. But yeah, you're right. Some really big names. I'm just having a look at the questions here, David. I hope I'm not taking away your thunder here. I don't see any questions on the webinar chat. I don't know if any of my colleagues do. We're a little bit over time, I think, by a couple of minutes. So if there isn't anything, we are always available. And I think that's what's important. Email's amazing. You can email Jeremy a couple of questions, and Jeremy can email that to us, and we can answer them for you as well. If you missed anything, a recording will be available, and we'll send it off to Jeremy, and Jeremy will distribute it amongst all of you. I'm going to give it 5 more seconds. Anybody out there got any questions? 3, 2, 1. That's it. Thank you very much for joining us. It was a pleasure to present to you all. Jeremy, really excited about the future. Johnny, always a pleasure. And thank you for all the support to everybody out there. Have a super evening. Tomorrow's Friday. And we'll do another one of these soon.
Thanks, folks.
All right then. Cheerio. Bye-bye.
Yes.